half, just to iterate on that, half the error rate on
Yeah,
on these predictions that than Zillow themselves got on their own data.
correct. Now, here's the difference.
I'm here with Nelson Lin today from Subtle Asset Management and also Subtle Asian Real Estate Group. When we were working together, a lot of the stuff we were talking about was super interesting, that you were telling me about, especially with your background of, managing property data and investment data to kind of help drive investment decisions. And with how crazy the real estate market got since we first started talking, because that was back in like what, 2019, 2020. That's 2020, about 2020. And so since then, had the pandemic, real estate went crazy, rates went down to nothing, cash investment went crazy. And so just I'd love to kind of get your perspective of starting in 2020 until, let's say, just end of last year. Um, Kind of what happened on a macro level in the real estate investment space. And yeah, just start with that.
That's a really complex question to answer. But
Yeah, that's true.
there are three main things that pretty much happened that caused so much change in the real estate market. The first one is interest rates, right? So interest rates dropped dramatically, which meant everyone could afford real estate. That, believe it or not, means actually a lot of home buyers got their first pick and choice of homes. Everyone's worried about these large corporations coming in and buying up single family homes. They are, but the share of single family homes that went to homeowners actually increased in the last 2 years, even though, like a lot of these investment homes were also bought up by corporations like BlackRock, Brookfield. So the thing to consider is, like, when you look at the actual data, more people who wanted to buy homes got the homes that they wanted than the corporations did. So the tide is actually not exactly in the favor, but of course everyone wants to be worried about the corporations because
Right.
it's like a bigger
It's a
headline.
better story. Yeah.
A better story, right? Interest rates are actually what made the biggest changes in a lot of these home prices appreciating, because the average person could then say, oh, wow, the cost to buy now, my financing is dirt cheap. So I'm going to throw money, buy anything I can. And then what happened was, once those Californians and New Yorkers, looked at their actual market, they're like, I can't actually afford this anymore, but I'm now remote. So that's number two. Remote work changed a lot of things, but the biggest one was people could go wherever they want to buy real estate. The group that I ran, it's national. So, I live in Austin, Texas. I chaperoned a lot of people in the last 2 years in town, just saying, hey, I'm in town, can I get you lunch? I'm curious about the Austin market. And I'm like, you and the entire country right now, so remote work was a huge push for that. And there's a few things that happened to different asset classes. Multifamily exploded and industrial exploded. Office tanked and retail also fell. Industrial exploded because of e-commerce, really taking off in that period. It wasn't just, Amazon or Shopify, like those businesses. It was actually grocery stores also.
Mm.
There's this concept of cold storage in the industrial space where you actually can't just deliver from a grocery store to someone's house. You usually want some
Mm.
sort of cold storage to maintain those groceries, and it's like a temporary warehouse location where you can then, from that huge refrigeration warehouse, deliver those groceries from a specific point. So people ran out of industrial space for storage of, obviously, Amazon and whatnot and those goods, but you also started running out of cold storage space, which also really took off in the pandemic. Those are the industrial sides. The multifamily side took off in all the states that you keep hearing about: Georgia, Florida, Texas, Tennessee, right? The American South and Southeast. Why is that the case? Is it because of their conservative or libertarian policies? I kind of doubt it. There's obviously a huge element to it, but the biggest one across the board you can see is it's just cheaper. Like everyone and their mom was like, I want to go somewhere where I can afford to buy a house.
Yeah, and population density is not quite as bad either. It's more spread out across a lot of
And
it.
spread out, you get more bang for your buck. And that's the biggest thing I heard from people who actually moved to, like, Texas and Florida and whatnot. Obviously, it's great not having to pay those taxes either, but there's plenty of states that have low taxes, but then at the same time, you have to, pay an arm and a leg to buy the real estate there. And that just never really appealed. So, for example, Chicago. Chicago has one of the lowest state taxes. They have a flat rate. So if you have a high income, you're at max paying 5%. But who actually wants to live in Chicago? It's kind of expensive compared to like a lot of other Midwestern places. And also, it's very cold. Location and being able to be remote, that changed a lot of things for the different migrations with between cities. And then also within cities, there's a huge change. We saw suburbs blow up because people who lived in downtown condos their entire lives said, hey, what am I doing paying, thousands of
Yeah.
dollars? All the restaurants are closed in downtown New York or LA, right? So they picked up and then they moved to the suburbs where they had more space, they had a backyard, they could watch the kids during the day because they were working remote. And so that was a huge trend that happened. Again, most of this applies only to high income, like the top 30% of income earners probably in the United States. You got to
Yeah.
pretty much college educated to take advantage of it. You got to pretty much have some, finger in the tech or finance space. Doctors, medical, you kind of got stuck unless you're a traveling nurse. So we saw a lot of those people move. That shift caused suburbs largely to blow up,
Mm.
which for the last decade, suburbs have actually already been performing downtown cores. Now, people want to buy downtown cores because like it's safer, that's where the jobs are, you know, but that's not the case anymore. That was something I
Mm.
told in the pandemic. Now, of course, there's back to office, but how many of those are actually going fully back to office? A lot of them are what they're doing is they're splitting it up and they're hoteling people in and out.
Right.
So what does that mean? That means you cut the office space you need by half.
Mm.
So you saved half of your rent at that point.
Sure.
So you're not going to buy or lease out more office space anymore. You're just going to maintain your headcount and then push more people in the remote as your company still grows, right?
Yeah.
And so those are the things that have changed in the pandemic market. The ability to be remote. The reason why it matters is because we've had a K-shaped recovery. If you're poor, good luck.
Yeah.
If you're in the top 30%, you've done even better than you ever had
Exactly.
in the last, 10
Yeah, I
years.
was gonna say it seems almost like it's creating just more of a disparity, if anything. Like it's not that it's necessarily taking away opportunities from everybody, but in a way it is because it's, like I said, it's a wage gap disparity being highlighted even more.
Yep. And finally, the third thing that changed a lot was the money pump, right? You
Yeah.
flood it with money and then you have a lack of supply for the money to go into, and that dramatically increases the value of mostly assets. If you're poor, the people who are poor, you're spending those Biden bucks on living expenses, rent,
Hmm.
you know,
Yeah. Not
they're
long-term investments.
not long-term investments. You might be putting some money into crypto because you think it's interesting and you didn't have
Yeah.
financial advice growing up, but you also can't afford the more expensive assets like real estate. So what do? You buy crypto and then hope it goes up.
Hope it goes to
Yeah.
the moon.
And
Yeah.
then what happened on the other side is now that all these ultra wealthy people were like, well, this is a good time to buy real estate because interest rates are cheap
Yeah.
and I can be more remote and I can travel, etc.
Yeah.
So the ultra wealthy, or not even the ultra wealthy, honestly, if you're in the top 30%, if you're college educated, you did pretty well
Right.
probably in the last few years.
Yeah.
If you are in the lower, minimum wage sector, it's, you know,
Yeah. With inflation going the way it is too.
if
Yeah.
it's
It's
where it is, your wages didn't,
wage appreciate. Yeah.
and so it only got worse if you aren't wealthy.
For
And
sure.
who all that rent, all that crypto, all those, all that spending you did, who that benefited? The ultra wealthy who already had investments before you entered the market, right?
Yeah, for sure. Yeah, just kind of caked it on top, and we'll come back to what my next question really is, but a lot of these points that you're bringing up are very well defined and very not just kind of guessing, especially the way you talk about it, and so that leads me to believe that they're backed by data, right? They're backed by analysis, and just also having talked to you before about how you advise your investors on what are smart financial investments and where to locate their financial assets. Talk to us a little bit about that because obviously this is developers as a service, so we talk about the more nerdy side of stuff, and so you can't give us a secret sauce. I appreciate that, but just talking in theory, or I guess in general practice across real estate investing in general, what are you seeing pick up as trends for the use of machine learning and data science?
Yeah. The hardest thing to tell people is that you can't predict the future. So any sort of models that say like I can predict where rent or where prices are going to be in a year, you know, 99% of that is vaporware, right? It
Mm,
exists because people want to believe in the dream, but you really can't predict the future with the past. You can only iterate, slowly forward. I won't give too much secret sauce, but something I built, for example, for one of the large real estate clients that I have, I built them a Zillow rent model, basically. They owned 10,000 single family homes. With that, that's enough data to build a machine learning model. It's very simplistic, just a statistical regression. We did the fancy way to call it is like it's ensemble models, right? So I ran some boosted trees and random forest and then a little more specific, but you can't really go beyond that. Any more than that, you start getting into this problem where you overfit on the data. And so it's great for your training data, but it's terrible for predicting on future unseen data, right?
right.
It's really hard to predict the future. There's some seasonality to it, but we got about half the error that Zillow got on the Zillow rent model.
Wow. Wow. Just to iterate on that, half the error rate on
Yeah,
on these predictions that than Zillow themselves got on their own data.
correct. Now, here's the difference. Zillow, most of their rental rates are from non-professional landlords, right? They're mom and pops. So if you have, an apartment complex or like a small duplex, for example, in Austin, you could just say, I'm going to charge like $8,000, even though everyone else is paying 2,000, right? You can do that because you're a mom and pop and it doesn't really matter. You're just like, I'm
Yeah.
doing it for fun and this is the only rate that I'll do it out for. And that's going to stay on the market for a while, right? Um, Sometimes they'll undercharge. They'll only charge 1,000 because like I just want somebody in there. I've owned this. I inherited this house from my parents who bought it in the 70s. So any rent is good rent as long as the tenant's
Yeah.
good.
Yeah.
So you have these outliers that kind of mess with the true market rent pricing, right? So you end up having this issue where you're pulling from data from different MLS feeds, but it's imperfect data, and it's data that isn't just for a duplex in Austin. You're looking at condos in downtown New York for rent also, and you're looking at a single family home in Milwaukee. And so the bigger and bulkier your model is, the lower the accuracy rate is because it's so general.
Right.
So the problem with the model that I built for them is anytime you go beyond single family homes in the South and the Midwest and like Southeast,
Sure.
if you try to predict rent in California, it just goes bonkers,
It's gonna be
right?
way more. Yeah. Yeah.
Way, but they'll never buy in California or New York or like downtown metros, right?
Okay.
Uh,
Hey,
Mostly.
but
Mhm.
I was just gonna say along on that same point, you could say the same thing about a property data analyst human, right? I mean, if somebody's lived in Florida their whole life and they only really know about the Florida real estate market, especially in their local area, and you try to ask them to predict about something in Milwaukee or in California, I mean, I feel like, kind of given the same data, they wouldn't, they wouldn't do much better.
Yeah. And so most of the data science parts of it is just common sense. And at the end of the day, a lot of what I'm doing that I went and got this stupid degree to do all this math for is just learning the bare bones of how the model works. But um, at the end of the day, it still comes down to like intuition and, is this a reasonable way to approach getting data, getting results, and
Mm,
can I actually produce something where I can generate money with this? And for
right.
Zillow rent, you can. So now what can you do with that rent model? You can underwrite a whole city, for example. You can
Mm,
find the best market that you want to. Other things I've done for them is create classification models that say like, all right, is this going to be class A, class B, class C, depending on the different census features? What level of asset class is it going to be, right? That's categorization problem.
right.
And if you're in machine learning space, k-means is probably one of the best models to do if you're trying to self-organize instead of doing everything by hand. Why is it that it works for someone like the hedge fund clients? It's because they own a lot of property. That's the main thing, right?
Yeah. More data.
More data. I'm a small fund. We're running like 200 units. It's like I can't really run much machine learning on that, to be honest.
Yeah.
Do some time series modeling and try to predict seasonality, but I can't do much with it other than just general base principles. And
Yeah.
so if I now have 10,000 homes, all that data is going to be proprietary. And they do
Mm,
the same thing with data that they purchase from other operators, right? So these seats are 10 100 grand a year just to get data. So then how can you as a small person compete?
Yeah.
It's the same thing as stocks. You
Yeah.
go and you buy small cap, right? You buy 5, 10, 20 units because you're not buying thousands at a time. So
Yeah.
when you do purchase, you can do more research. You can be more careful about your products that you're analyzing because, um, at the end of the day, in order for these funds to grow, they have to keep scaling. And so what they do is they might have some that are duds in the portfolio, but then they want maybe 60, 70% of them to be knock it out of the park projects. And that
Sure.
outweighs the, 20 or 30 that they lose. So, there is a cautiousness that you can have more of as a smaller investor. And
Mhm.
you take machine learning principles, you know, you don't even have to do that. Zillow has free data. Fred, the Federal Reserve Economic Data, has free data. Um, there's a lot of ways that you can outperform a larger fund because you're doing everything by yourself, and you're being more cautious about that information. Because the way these funds purchase homes, it's like it just fits a category, boom, shoot for it, buy it, right? Whereas
Yeah.
you as a local investor might say like, hey, that's R1 zone. So one day I can add a back, unit and then I can generate more income with it. And those, hedge funds aren't going to touch that. They're like, that's too much
Yeah.
work. We have all this money. I don't want to
Yeah.
do it. It needs to be renovated. I'm going to buy something that's already finished because that's my superpower. I, as a fund, have billions of dollars at my disposal. So why am I going to waste my time worrying about adding back units and then getting
Right.
process of permitting with the city, right? So
Sure.
that's kind of my perspective, at least in
Sure.
terms of how you as a small individual investor might outperform a larger hedge fund.
Right. Yeah. And that's the trend that I see too, is data is just it's already been the new gold. Like everybody says Bitcoin is digital gold, but user data, investment data, property transaction data, all this kind of stuff that can be taught to a machine learning model, to a prediction model,
Yes.
that's true. That's true digital gold. And so I try to tell people that, if they want to do one thing to increase the lifetime value of their product or service, is collect data and label it
Yes.
accordingly. That'll definitely help out the most. So one thing I wanted to ask is on state of adoption, right? So in terms of companies, especially the bigger hedge funds, even obviously they've already adopted it because you're doing a lot of this work for them. But, you know, it can still be, I've noticed in the machine learning space, especially, it's like one or two big players are really leading the way with investment and, having grants put together for these different types of programs versus it becomes standardized, like across everybody's kind of part of it, how they do business
Yep.
is they include machine learning models. So where do you think it's at kind of on the scale in terms of the real estate investment world?
So it's really hard because real estate is a lot harder to systematize than other industries. It's very capital intensive. Believe it or not, it's also people and relationships intensive, right? So every deal has three parts. I like to say in real estate, there's the actual deal itself. Is it a discount? Then there's the money. Like, can you get better financing than other people, or can you raise more money than other people with lower returns and then get yourself an outsized return? And then finally, the third part is experience, right? Your
Mm.
operator. You can't scale up people through operations, and so or specifically, you can't scale up relationships quickly. Um,
Yeah.
and what happens is there's a lot of people from the tech side coming in and thinking that they are smarter than the real estate people. They will go all in on the algorithm. What we've seen, at least in the last 2 years, is that all the e-buyers who went in on the algorithm are all
Overshot.
they
Yeah.
they all dumped the e-flipping,
Yeah.
right?
This is Zillow, Redfin, Open Door.
Yeah, the list goes on, but that's what we've learned is that if you trust too much in the algorithm and not enough on your contractors, your uh, project managers, your agents, you can't really scale those up quickly because those relationships take time to build and also time to test and trust, right? And if you're in tech, you break this, it's like, great, we're going through a spend through a week. We're going to break it 8 or 9 times before we come out with a good product.
Mm.
Real estate, you don't really figure out if someone's bad until like 6 months of hiring, and you're like, why is this person underperforming? And hopefully you've got enough skill that you have like 3 other agents working with you. You're like, hey, this leasing agent is performing at half the rate as my other 2 leasing agents, which by the way, you can't really get to that size until you have at least like 90 to
Yeah.
200 units or something like that, right? And so you look at that and you just, you're like, how simple is this math? It's like you really have 3 agents worth of data on a
Mhm.
large building that costs you $100 million. How many of those can you actually purchase? How many data points can you actually collect from that without
Yeah.
having a large amount of money? And so the convergence that I'm seeing is that the people who went from the tech side into real estate are all going out of business
Yeah.
because
Yeah.
they thought they could just automate things and do it better than things in the past, which honestly there's a lot of opportunity for growth, but they ignored the base principles and the fundamentals when it comes to real estate, which is
Right.
experience, money, and good
Yeah.
deals, right?
And it almost seems like they overgeneralize their data too a lot, like you were saying with the default Zillow model that was trained on everything, is they just kind of they were too generalized about their markets. And
Yep.
yeah, that's
They're
and
holding
you hate to see it. Yeah.
hate
You
to
hate
see
to
it though.
see it, and you hate to see it with crypto too. It's the same thing. Everybody was like, FTX is crypto. All right, let's invest. Like Kevin O'Leary says it's good. Let's do it,
Yep.
you know?
Yep. Yep. So
But at the same time, I guess you could say a silver lining maybe is that it sounds like it introduced the algorithm a lot more than before.
yep.
Like the real estate market beforehand was more so, like you said,
Yep.
relationship heavy, but now it's bringing in a tech side too.
Yep. So what I've seen success in, at least for the hedge funds that I've been, doing some work for, they start from an operating business first, and then they layer on some tech with it, right?
Mm,
So, I went into their systems. A lot of them seem to be running on your standard SQL databases still, by the way.
mm,
And it's like,
yeah,
I'm like, this is 8 rows of replicated data. Like if this is a NoSQL thing, you could have saved yourself, 8 rows of data, and then
yeah,
your search function now would be way easier if you use Elasticsearch. But they're like, yeah, but then we have to hire another engineer to like set it up, and
yeah.
you're like, yeah, of course. But the effort that
So
you save now
yeah,
is going to bite you in the butt as you pick up
mm,
more properties, right?
yeah,
Uh, so uh, but they're getting more into the tech side, and I'm starting to see a lot of results come out of that, namely because they're doing things at a scale that their other real estate smaller competitors can't do,
hmm,
and that's kind of where they're going to stand out, is taking advantage of machine learning, data science, and specifically their own personal data that other people don't have access to, right? They're able to outcompete because they can bid faster, renovate cheaper, and change the prices on their rent faster so that they can get at least for the minimum amount of rent that it would cost them.
One thing that I definitely want to make sure I cover and ask you about is, of course, the so-called bubble, right? So
Yeah, yeah,
everybody always wants to talk about the last real estate bubble and how it crashed, and then how this one's going to follow suit and it's going to be an even bigger one. But I got to say, from everything you told me, it does not sound
it's
similar, because the last time it was insecure money, and now this is all very secure money that's flooding
exactly.
into the market.
Yep. So what people don't realize is last time around it was an oversupply due to bad money, and generally everyone thought they would make money because they were working on this principle that real estate had never gone down in value, and it's true. Actually, if you look prior to 2008 and 9, every other recession, real estate actually went flat, or actually went up a little bit. If you look through the actual historical record dating back to, I think, the 1950s, if you Google and look up Fred Case-Shiller index, you can actually see that transition. And then there's certain cities that it didn't even touch. So there's a few things that people don't realize when it comes to data science, and there's a lot of colloquialisms that people take that are incorrect. So, for example, one thing people used to say a lot is that uh, uh, gateway cities, so your main cities like New York, San Francisco, they're safer than your secondary cities like Austin or Denver or Phoenix.
Mhm.
That's the case, actually. San Francisco, New York, they fell harder. Markets like Denver and Austin, because the money didn't go there in 08, 09. In
Yeah.
Austin, it fell by like 3 or 4% in terms of prices on average because you didn't have a bunch of dumb money funneling into this smaller city at the time. And so it's just a matter of does the returns match the fundamentals of what it deserves, right? So that's the question everyone has to figure out for themselves. That's something I always try to bring up is what you say is not always correlated to the data. So that's the
Sure.
news, which is, major cities aren't always going to be safer than your smaller
Sure. Yeah.
now, that being said, this time around, we're seeing that same effect. The cities that everyone heard of the most, Phoenix, Austin, they're falling pretty hard. And the hardest falling markets in the last, 8 months that we've had this decline, it's pretty much San Francisco and San Jose are like falling cities because it's
Oh,
related to all the tech industry. And the closer you are to California, the smaller the fall. So Phoenix is getting hit real hard right now.
yeah.
Reno is getting hit real hard. And then the
Oh my
further you
gosh.
get out to Texas, it gets like smaller and smaller, right? And then
That's
Austin
crazy.
is starting to see a pretty big hit too.
Yeah.
And this is what I was talking to you about earlier, which was people who got remote decided to dump money. So the New Yorkers are coming back and forth because financial services are still fine. So the Eastern Coast cities, their real estate is more or less stable. Florida is actually still going up. It's one of the places
Mm,
to invest in. Um, but it's also where I see a lot of the hedge funds going into. So, if you're
sure.
looking to Florida,
Yeah.
um, but if you look at San Francisco, LA, San Diego, they just got smoked, right? And what
Yeah.
happened was they couldn't afford California, so they went a little bit further out, and then they started investing in Nevada, Arizona, and then they couldn't afford that, so they went a little further out to Texas, right?
Yeah.
It's like, the closer you are to California, the redder that dot gets.
That's
Right?
crazy.
Yeah, the closer to California you are, the redder the dot gets, right?
Yeah. Yeah.
Um, and so um, that's what you have to remember is hype does affect a city. And so
Sure.
don't just listen to what other people are telling you. You have to figure out, does the value match what this building is worth? And right now,
Right.
the tech bubble is popping.
Yeah.
And cities that
The
were dependent on tech growth are getting hit by the tech bubble popping, right?
mm,
Because real estate correlates to income,
yeah.
rental, into rental, the rents that it generates. Now,
Right.
that being said, is there actually going to be a pop?
Who knows?
Who knows? I can't predict the future, but
Yeah.
there's like a very high chance that it's not really a bubble, right?
So that's the thing that I've been seeing too is like if it is a bubble, it's like a rubber bubble or something because it's
Yep,
very flexible, it's able to
yep,
move because like the bottom has to fall out on one of two things. Remote
yep,
work has to become immediately not okay, has to
yep,
get canceled essentially, which we and like crazier shit has happened, right? Like crypto
yep,
just got canceled,
yeah.
right? And nobody thought that was really gonna I guess that's not true. There's a lot of
There's,
speculation involved.
there's quite a few people who
Yeah.
had it.
Yeah, I guess that's true. But, it got as big as it did and still crashed. And so, you know, that's kind of where you look and you're like, all right, if remote work completely collapses like Twitter, like it seems like Elon Musk is trying to do, he's like, hey,
Yeah,
you need to be within working, driving distance from here. But a lot of startups I talked to are still like, no, we can't afford an office. We're not going to get into a
yeah.
lease. You can
Um,
work from home.
yeah, so it's like 50-50 right now, but the trend is still going towards remote work, right?
Yeah.
Um, and so the thing you also have to think about is that a lot of people who moved were already planning to move. I saw the stat. Basically, two things affected. One was it's cheaper, and two was they were already planning to move to the city even before the pandemic happened, right?
Mm,
And the pandemic happened, they just sped it all up and decided,
mm,
screw this, we're just going to do it because now's the best time to do it. And everyone kind of followed that structure. Now, that being said, I actually didn't finish up on my point too on
okay. Go ahead.
where prices are going. Crypto fell because it is an intangible asset that doesn't really have a monetary value other than what people say it's worth, right? Um, it goes up because people say it's worth more. It goes down because people say it's worth less, right? Unlike the U.S. dollar, you at least have like a uh, an army that says like it's worth $1. You take it,
Yeah.
run, right?
Yeah.
Um, Real estate does well because of cash flow. That's the main thing. And there are three things that determine the price of that I see as a lever in terms of how much can um, how much can home values adjust, right? Three things. Number one is wages. Um, they're at an
Okay.
all-time high, right?
Yeah.
So they are also still increasing because guess what? We can't find enough people to afford houses, right? Or
Mm.
can't find enough people to have jobs for.
Right.
Wages will support an income for paying rent or paying a mortgage, or hypothetically, you as the owner of the house can hold on to the home for as long as you need to. Right? What happened in 08, 09 was you're a waiter and you could tell the bank, hey, I make $1 million a year. Can I borrow three houses?
Yeah.
And they
Yeah.
said, yeah, for sure. Give
Yeah,
it,
sure. I mean,
yeah,
why not?
20%, interest rate. And the assumption was that, oh, homes are just going to keep going up forever. And then when I sell, I'll just make more money. Right.
Yeah.
And so that has gone away since 08, 09. You have like, a stack of papers you have to fill out before you buy a house now in order to get a loan. And that existed because of what happened in 08, 09 was people constantly lying about their income that they generated in order to pay and afford for a house. So as long as incomes remain high, which hopefully they do, and the wage market is still strong, I don't really see home prices coming down that much in terms of wages. Number two is the factor that everyone else is talking about right now, which is interest rates. Interest rates are higher, mortgage payment goes down, but there's a lack of supply for the homes. So even though people can afford less in terms of homes, you know, they still want homes.
Yeah.
Um, a friend of mine, even though the market's declining, she went to an open house recently in Rhode Island, and she's like, "Yeah, there's lines right now," and you
Wow.
know, there's somebody in my network who just said, "Hey, I'm trying to buy this house. It already has multiple offers on it in San Diego," and so yes, prices are high, but people still need homes. They still need a
Yeah.
place to live, right? So interest rates can reduce demand. They can also increase supply. Um, right now, it's on this decreased demand, but we're still in an overall supply shortage. So the interest rates, to me, are just a market um, way of correcting supply and demand. And the third thing people don't talk about as much is rent. If your rent stays high, you can support a home forever, basically.
Yeah.
You look at the historical record for rent, look up Google Fred CPI rent index. Rent has never fallen.
Mm.
In 08, 09, rent went sideways and then went right back up on average across the United States. Obviously, if you're in a small oil town that booms and busts, rent goes down. If you're in San Francisco during COVID, it dropped pretty quick and then it went right back up a year later, right?
Mm.
But historically, on average, rent has never collapsed across the greater United States. It has, in the case, and the reason for that is the people who lose their homes that got foreclosed on 08, 09, they still need a place to live, right?
Yeah.
Shelter is a commodity. It's food, it's water, it's medical, it's things that you need to survive. And so at the end of the day, real estate is a stable asset that more or less tracks with inflation. Rent is an asset that tracks with inflation. Home values are not. Home values can collapse overnight if you have too much supply and the interest rates are too high and people can't afford it with their incomes, and the rent that you generate from the home is not enough to cover the monthly obligations that you owe on the house. The people who survived 08, 09 were mostly multifamily landlords. Even though the market has kind of fallen a lot for single family homes, multifamily permits and new developments are still at an all-time high because rent was up 10, 20% in the last year in your city, right? So financially, it still makes sense because rent is a commodity, shelter is a commodity.
Oh, I see
Yeah,
what, yeah, I see what you're saying now. So we're building more homes, supply's still going up.
we're at a recent low for new single family home builds,
Okay.
but apartment complex multifamily builds are still growing.
And because the bet is that rent is not going to go down. Like, even if
Yes.
it's not going to be as much as a single family home rent, it's still going to be 20, 30% higher than it
Right.
was 2 years ago because it's the location.
Yep.
That's crazy. So when we talk about, tinfoil hat, you're gonna own nothing and be happy with it.
Yes.
Like, people are like, oh, that's not the case. There's gonna be a correction, something's gonna happen. And so the
Yeah.
only option outside of, like I said, remote work not becoming a thing anymore, like it's canceled, you can't do remote work. That's probably not gonna happen. The other thing is nobody rents anymore, like rent goes down, and that's what you said, probably not gonna happen, right?
If
Because it's
you
never
want to buy a
happened.
house, you wouldn't need to rent, so
Yeah. So that's never going to happen. And so the only other thing that I really truly think it would be, and this would be insane, but like we said, crazier things have happened, is legislative action that puts, like, I've heard a lot of talk about, they're gonna put restrictions on um where you can buy a home, how many homes you can buy, how close you have to live within vicinity of those homes, and it's not gonna wipe out the investment market per se, because a lot of people do invest in their local markets, but it is going to have a pretty big impact where now a lot of people who who normally would buy those homes and own those homes are not legally allowed to. But even then, I guess it's just going to cause monopolization in the market, right? Like in a local market.
Sure. I was actually gonna go there next. The more you try to regulate it, the more it actually hurts your mom and pops.
Uh,
But you know who's gonna be able to still buy up homes in mass, apartments in mass? Corporations. People are gonna raise shitloads of money and then buy up, real estate everywhere and everywhere. All it does is cut out the middleman, or at least cut out the smaller investors who are no longer able to jump that huge gap between, from 3, 4 units up to like 100 units, right?
mm,
So at the end of the day, you can't push that regulation, but it only hurts the small person, the smaller
sure.
investor, the mom and pop investor more than a larger corporation does.
Well, the
Um,
government would never want to do that, right? They would never want to hurt mom and pop. That would be
yeah.
terrible.
No, why would they ever hurt
It
mom and
would
pop
be awful if they would
to
do such a
prop
thing.
up large corporations? Who would have
Yeah,
thought?
never. Unthinkable.
So,
Well,
um,
so I don't want to end on a totally depressing note, because that's super depressing if you're, 22 years old and you live in, the boondocks and you're not born into wealth and you're
yeah.
trying to, figure out how you can own a home. So, on a more positive note, one thing specifically that about the group that you're doing that I like, subtle Asian real estate.
It's open to everyone, by the way, and
It's
no,
open to everybody. It's just a
leaning on
meme
the
that
Asian
it's
thing.
called subtle Asian.
Yeah.
Awesome. And so it sounds like you are very much aware of that disparity that has become even more kind of apparent in the couple of years during the pandemic, as property ownership has shifted so dramatically. So tell me just, kind of a little bit about what your goal is with that group, and, how you kind of hope to help.
The group is mostly the demographic that I come from. Um, my parents had a third grade education from China. Um, they were undocumented for a long time, and when we came to the U.S., and I wanted to, when my mom wanted to buy an investment property, I asked her how she wanted to do it. She's like, "Oh, I'm gonna pay for a single family home cash." I'm like, I don't think that's how that works. I also
Yeah.
didn't have to invest, but I didn't have like a rich uncle I could be like, "Hey, how do you do this?" Right? And so this group became that. We just became rich uncles for each other, which was,
That's
how do you
awesome.
not make a big mistake on the first large purchase of your entire life, right? Likely the biggest purchase of your entire life. And so um, it brings me a lot of joy when people, like, probably once or twice a month, I'll see this. It's like, hey, this group is the reason I bought a house. And even though we're 20,000 people, like 20, 30 people a year tell me that, that's,
Yeah.
hey, like,
Yeah, that's
that's
awesome.
that's what the group is for. That's what makes me feel like we're doing something impactful. And it's like, I'm happy with the amount of money I'm making from, the real estate investing side. um, and so this group is like a way to give back to the community and to be that rich uncle for someone like me who didn't really ever have one. um,
Sure.
but majority of us are West and East Coast, high income W-2. Our parents all told us to go into finance, tech, or medicine.
Yeah.
That the main demographic. It's like the people who benefited, like I said, unfortunately, and the top
Yeah.
30% from the recent policy changes. Um,
Mhm.
they all love real estate because their parents came from countries where you weren't allowed to own real estate. Yourself
Gotcha.
probably owned it, and so they trust in real estate a lot. And we talked about this actually. So China, like their real estate values are falling by a lot because they didn't have this concept of like match income to prices, match rent to prices. Rent will make nowhere near your mortgage payments in China, and the
Wow.
prices astronomically because you can't invest in crypto. All the stocks are insider traded, so you can't trust the market,
Yeah.
right?
Yeah.
So what else do you have that you actually have some control of? Real estate, and they just bought a bunch of that over the last few years because that's the only asset that they trust. So yeah,
Cool, man. Well,
the light,
how can people find out more about it? How can they get connected?
our Instagram is subtle real estate, or subtlerealestate.com. uh Happy to reach out. I'm Nelson Lin Sanity on Instagram as well, if that helps. Let's see. Yeah, those are probably the best ways to reach out to us. We reduce the number of ads, and it's mostly people answering questions for each other, and then a bunch of photos of our meetups and the cool stuff that we do. So
Sure. Cool. Awesome, man. Well, I appreciate your time. I know we only scheduled like 30 minutes, but
no
it's
worries.
fun talking about this stuff. And I have even more I'd love to talk about with you
Yeah,
later on. But you know, Happy New Year. I'm super excited to see in a year, let's say, what happens with our predictions of what we think is going to happen
yeah,
if we're all living in containers. If you're less than, $200,000 a year, you're living in a container. And if not, you get to go to the top and live in a real house.
yeah, yeah.
So
Yeah, but my predictions for 2023, prices are probably going to stay flat or down 5-ish%. Five. I don't see it wholesale collapsing, and it's going to go up again actually in summer, and then it's going to fall right back down, and then it'll probably fall down like below right now January 2022. January 2023 is either 0 to like 5% less than what it is today, probably.
I I'm gonna say that there's gonna be a new boom of Silicon Valley somewhere else. I think Silicon Valley is just gonna move. I
Yeah,
think I think it's gonna be like Austin or Miami or Atlanta, somewhere in the southeast, like you
yeah,
said, these kind of nesting grounds for all the people that came. I think there's gonna be a new Silicon Valley, and I think history is gonna repeat itself. And
yeah.
I think everybody's going to want to sell their suburban homes and they're going to want to invest in property in the city again because they're going to miss out on the crazy freaking
There's
insane
going to be a
returns.
FOMO back for the main city for sure.
Yeah, so that's the only counter argument I would say is I think history is still like people still want to be with people even though remote's more
Yep.
convenient now. So I think there's going to be a big, super big Silicon Valley push in somewhere in Texas or Florida, and then we're going to see just a different but similar market. But we'll
Yeah.
see.
Yeah. We'll see. All right.
All
Good talking to
right,
you.
Nelson, thanks so much for your time, man. I appreciate it. And if anybody wants to join Subtle Real Estate Group, join out to him. Reach out to him. Awesome.
Bye.
Thanks, man. Bye.